Okay, so chapter 17 is investment management. We're going to look at a lot of risks and systematic and strategic and asset allocation. It's quite a nice reading. So we're going to start off with systematic and specific risk. Do you know anything about them? No. Okay, so there's a little mnemonic that I use, and it's called SUM and FUD. Now, systematic risk is undiversifiable because it's market related. You can't diversify away market risk. Now, FUD is firm, unsystematic, and it's diversifiable. Diversifiable. They do also use a word, not in foundations, but in level 1, and it's called idiosyncratic risk. So this is just how I remember it, because in level 1, they use them quite interchangeably. So systematic is market risk, and specific risk or unsystematic risk is diversifiable. Now, why do we diversify? To decrease risk, and that will generate higher returns. So total risk of a portfolio is systematic risk, which is your market-related risk, plus specific risk, which is risk unique to companies, and that equals total risk. So specific risk, we diversify. How? By investing in more than one or two assets. So another thing that we look at is correlation. How do the assets move together? And that's also an important thing for reducing risk. We obviously don't want positive correlation, but we don't want perfect negative correlation as well. When one goes up, the other goes down. So we just want it to be less than positive, perfect positive correlation. Okay, so here's a graph. We can see that if you only invest in, say, 3 shares, your risk is going to be quite high. But as soon as you start investing in more stocks, or what you can do is you can invest in stocks, bonds, and say commodities. And that will definitely diversify your portfolio. So you can see as the more you invest in different stocks, the specific risk decreases. Because remember, we can't get rid of systematic risk. Okay, but what they say as well is anything more than 30 shares, the costs really start to outweigh the benefits, because obviously you have to pay more as you invest in more. So then you're going to have to get a greater return. So they say you shouldn't own more than 30 stocks. Obviously you can do whatever you want to do, but this is just what they say. So by diversifying, what do we have to look at? We have to look at asset allocation. Now remember from last week, we said the first step in any investment for clients is looking at the IPS. Okay, what does that show us? Remember, it just shows us the objectives and it shows us the constraints. So what is your client's objective? Are they short-term or long-term goals? And what are the constraints? How much assets do they have? How much money do they have? What is their income? That kind of thing. So once we've got the IPS, then we allocate where our assets. What questions do we ask? What asset classes? Obviously, if they're willing to take on and have the ability to take on risk, they'll invest in equity. If they're quite risk averse and don't have a lot of assets backing them, we'll invest in less risky stuff like bonds. And what portion of the portfolio? So If they're 50-50, you'll obviously put 50 in equities and 50 in bonds. If they're willing to take on more risk, you can put 60% in equities, 40% in bonds, just kind of what portion should be invested in each class. Then, through asset allocation, we can either be strategic or tactical. Okay, but strategic allocation looks at the long-term mix of assets. So it's your long term. Okay, and this long term obviously is to meet the investor's objectives. Okay, with strategic asset allocation, we're looking at the overall risk and return from the IPS. So look at overall risk and return objectives. Okay, so what is your client's long-term mix? Okay, remember I said if they willing and able to take on higher risk, you'll invest in stocks. If they have low risk and low return, obviously we'll go into bonds. So just, we need to look at the IPS, looking at the long term, we look at strategic asset allocation, and then we see where we can invest. Okay, so what is the strategic asset allocation process? Okay, we look at the expected returns. Okay, and that's what we estimate first. Because what's the point of doing anything else if we don't look at the expected returns first? Then we look at the risk measures. So how risky is it over the returns? So in a later reading, we're going to look at returns per unit of risk. And that's where this comes in. And then we look at the correlations. So there's obviously a government bond and an equity are not perfectly positively correlated, but they might have some correlation. So if the whole market crashes, obviously both are going to decrease, but also depending on what equity stocks, how related it's going to be to government yields. Okay, so once we've done all the estimates, then we allocate. Okay, rebalance is necessary. Obviously markets change, your clients' objectives and constraints change. And remember, we usually do it everything annually. Okay, so that's the minimum requirement, is to always meet annually. So this is just to see if the financial status of your clients changed or if the portfolio has deviated from where it was measured. Okay, now tactical asset allocation. Okay, so remember I said, okay, SAA, not the airlines, strategic asset allocation is long term. Okay, now your tactical asset allocation is your short term. Okay, so this is when a manager spots like a short-term fluctuation in an asset class and he wants to exploit the opportunities to increase the returns. So it's only going to be short term. So if we say your client was invested in 60% bonds and 40% equity, but there's like you're almost certain that equities are going to outperform, then just for a bit you might change it to 50-50. And then once you've exploited the opportunity, you'll change it back to 60-40. So it's just a short-term thing. Yeah, do you understand the difference? Cool. So obviously here, you always start with your strategic. Can fluctuations of the returns be exploited? Tactical, then you just change it back to your long-term goals. Okay, so what factors affect tactical asset allocation? Okay, so obviously the economic conditions. Okay, so if there's a boom in the economy, quite a few of the equities will increase. Political conditions. Now we're going to look at bonds, obviously, if there's corruption or just a big recession, the bonds are going to decrease and you'll put more into equities. Central bank policies, that's looking at your repo rates, how your interest rates are changing, also deals a lot with bonds. Okay, current valuations versus historical valuations. So that's basically just looking at past trends. If, say, where do you get a lot of Christmas presents? Say like Toys R Us, every December, they increase. Why? Because people are buying presents for their kids. Okay, that's a really bad example, but you kind of get what I'm saying. Recent market trends. Okay, so last year, Bitcoin, or the year before Bitcoin, looking at the market trends, there's always been an up, then there's a down, but this has been quite a long down for whoever's invested. Okay, so managers may look at the strength of the economy and future trends just to gain a perspective of how the central bank might change interest rates and then how that affects everything else. So they're quite linked. Economic conditions, political conditions, central bank, they're all quite linked. Okay, then we're going to look at passive and active. We have also discussed this before. So remember, passive management, they try to match a benchmark. Active management, they always try to outperform. Which one was more costly? Yes, okay, costly and less costly. Why? Because they need constant evaluation. They obviously always need to be watching the market. They need to be watching the firms. They need to be working out all the fundamental values and then changing all the time. So you can see that active sometimes beats it and then sometimes doesn't. Okay, so what they actually say is that passive management tends to outperform active management. On a whole, you basically just need to get one good investment manager, but most of them actually underperform. So we can see here that passive management, why do you think it's below most of the time? Yeah, because what they say is that you're not always going to be able to invest in all the shares in the benchmark. So then it's going to be hard to exactly match the benchmark. Active management, same thing. If they can't invest in all the shares in the benchmark, obviously it's going to be hard for them to outperform. Okay, so what are you going to invest in, passive or active? Okay, we said costs. Passive is typically cheaper. Okay, needed to outperform. Active managers must either have access to better information. Okay, so they need an advantage over passive managers, or they need to be able to respond and use the information faster or have better models in the process, the information than other investors. Okay, so what they also you need to notice is that your returns have to be greater than the costs. Okay, because remember, active is quite costly, so your manager actually has to outperform to cover the costs. Otherwise, you're going to constantly be making a loss. Okay, unique products such as real estate, okay, in which all appropriates are unique and trading is done in private transaction. Okay, it's less clear how a passive approach can be used here. So even though passive is buy and hold, and so is a real estate, okay, it's technically just private transactions. Okay, and performance, okay, we've obviously said passive tries to match the benchmark and active tries to beat the benchmark. So here they say most active managers have average or below average records. I know, why would you even go active? Okay, identifying and capturing market inefficiencies. So we've looked at fundamentals. Okay, this is your detailed analysis. It's trying to find your V0, which was your intrinsic value. Okay, it's looking at all your strategies. So what you'll do is and a manager will go and meet with companies and try and identify companies that have better prospects. Then they'll look at the value of the shares compared to the prospects plus your intrinsic value, and then you'll look if it's under or overvalued. Okay, it's a little bit of quantitative. They work quite well together. Your technical and behavioral analysis. So we know technical analysis looks at the trends, so all the patterns, the flags, the pennants. You'll learn all of that next year in quants. Okay, they look at momentum. Behavioral analysis, you're looking at people. Do people act rationally? No. So you really have to focus on what people do. They always want to sell at a peak and buy at a trough, but do they? No, they wait for trends to be up. Then they see it's going up, and then they buy, and then what do institutions do? They sell. So you need to be a really rational investor if you're doing it by yourself. Then your quantitative analysis, okay, that's looking at your ratios, so like your PE, your EBITDA, your return on assets, okay, just looking at expected earnings, those kind of things. And you also want to look at if the company is high growth, if it's a value stock. Generally, try and find those that tend to outperform the market. Okay, that was a quick reading. Okay, this is a big reading in level 2. It does come up in level 1 a bit, but bigger in level 2. Okay, we're looking at risk management. So what are we going to look at? We're going to look at your standard deviations. We're going to look at your VARs. How do you manage risk? What do companies do to mitigate risk? Those kind of things. So in everyday life, how do you mitigate risk? Insurance. Okay, home, car, life, medical aid. Those are how we mitigate risk, but obviously we're going to be looking at it from a company's perspective. Okay, so what is risk? Okay, it's the effect of uncertain future events. Okay, so we don't know what's going to happen in the future. So what do we need to do? We need to try and mitigate how effective. Obviously, we can't predict what's going to happen in the future, but we can try and ease it out. Okay, so risk is uncertain future events. Okay, external, so obviously that would be like a recession, nothing we can do about it. Okay, internal, fraud. Okay, obviously then we can try and do some preventative measures. Okay, and we can look at if they're negative or positive. Okay, you get 3 classifications of risk. Okay, so first we look at the source of uncertainty, so we need to identify. And then we classify. So you get operational risk, which basically refers to the losses from inadequate or failed people or systems. So like a technical failure or contractual failure, those kind of things. Then you get compliance risk, which is your failure to follow laws, or fraud, that kind of stuff. They put fraud here, but compliance risk, I think it would go into both. So also like after a company has like been accused of fraud, they'll obviously face sanctions, and that falls under compliance risk. Then you get investment risk, which is like the fluctuation of obviously your investment returns, but we're going to discuss this in a bit later. So we're going to look at all of them individually. Okay, so the importance of risk management, I'm just going to write the definition quickly. What we're going to discuss now, this is basically the definition of risk management, but I just put it in a more formal way. Okay, so risk management is a process affected by an entity's board of directors, management, and other personnel. Okay, it's applied in a strategy setting and must cover the whole firm. Okay, it's designed to identify potential events that may affect the entity and manage risk to be within its risk appetite. Okay, what is risk appetite? How much risk can the firm take, and how much is it willing to take? Okay, and why do we do it? It's to provide reasonable assurance regarding the achievement of the entity's objectives. Okay, and basically how it goes is it goes 1, it's a process that is a series of actions to achieve a company's objectives. 2, it's typically driven by a company's mission and strategy. 3, one of the main functions of risk management is to find the right balance between risk and return. And then 4, a common corporate objective is to create value in a business environment that is usually fraught with uncertainty. Okay, so who is involved in risk management? So like we said, it's the board of directors. Okay, it's the senior management and other personnel. Okay, these are critical as they set corporate strategy and the objectives. So obviously they need to look at the risk that the company faces before they even figure out what is the corporate strategy and strategic objectives. Okay, even though they set it, obviously we know that the whole company needs to know what the risk management is, because it only takes one person to mess up everything. Okay, what is the risk management process? Okay, so we start here. We need to set the objectives. Okay, then what do? We detect and identify events that could potentially harm our company. We assess and we assess and prioritize risk. After we've assessed and prioritized them, what do? We select a risk response. Then we control and monitor, and like always, we repeat the cycle. Okay, so setting objectives. What is our risk tolerance? Okay, so that is the ability and willingness. So last week we looked at it from the client's perspective. Now we're looking at it from the company's perspective. So the ability to handle risk and the willingness to take on risk. Okay, strategic objectives. Okay, what they do is they help identify potential events and then make a decision on how to stay on track and achieve its objectives. Okay, and that all links to operational objectives. Okay, detect and identify. So this was step 1 in our circle, was identifying the potential risks. Step 2, detect and identify events. Okay, the next step is to detect and identify events that may affect the company's objectives. Okay, the outcome of events can be negative, potentially leading to a loss of earnings or assets, or they can be positives. The higher risk, the higher return. So if it works out, obviously it will be positive. If it doesn't work out, it'll be negative. Okay, the aim of risk management is to try to capture the full range of risks, including hidden or undetected ones. Okay, therefore, companies should involve staff who are in different roles and business areas to detect and identify as many events as possible. There's no point in just looking at one area of the company when it only takes one person to mess everything up. Obviously, you need to have different objectives in place for risks in every department. Okay, therefore, no matter how hard people try to reduce risk, can never be completely eliminated, like a recession. There's literally nothing you can do about it. Okay, but risk management just helps the company prepare for these adverse events. Okay, step 3, we're looking at assessing and prioritizing. Okay, this is just a picture that they show you how they can. Okay, expected severity and expected frequency. So how harmful is it and how likely is it to happen? Okay, so obviously if it's green, there's not going to be much effect and it's highly unlikely. And if it's highly unlikely but catastrophic, like the 2008 crisis, then it's going to be black. But we need to start worrying big worries after red, but we need to monitor these ones quite closely. And if it's green, obviously, we don't really need to worry about it. Okay, both the expected frequency of a risk event and the expected severity of that event need to be considered when prioritizing risk and the appropriate response. Okay, a risk response. Okay, response strategies. Okay, tolerate, so accept risk and effect. Okay, in some cases, risk is well understood and taking it provides opportunity to create value. So that's like your high risk equals high return. Okay, treat, need to take action to reduce risk. Transfer, move the risk to a third party. What is that? Like your insurance. In derivatives, it's your CDSs. Okay. Or we terminate, avoid the risk by ceasing the activity completely. Okay. How would they kind of ask this? They would say, if a company's risk response is to transfer the risk, or they say move the risk to a third party, They'll say, which is it, tolerate, treat, or transfer, and then you'll have to know that it's transfer. Or they'll say, like, which of the below is not a response to strategies? And they'll be like, tolerate, treat, and time, something like that. And then you just have to know which four. That's the only way I can think of them asking this. Okay, control and monitor. This was step 5 and the last step. Okay, so taking action involves a range of controlling and monitoring activities that must be performed in a timely manner. Okay, after that, relevant information must be identified, captured, and reported. After that, we have enterprise risk management. Okay, this is basically helping a firm bring all of it together. So it consolidates and manages risk at the firm level. Then it should be iterative and subject to regular evaluations and revisions. And each year we complete the cycle like we do. What I would think here is probably the most important would be this, selecting a risk response. Okay, risk management functions. So what they say is this is the first line of defense. Okay. Employees and managers face the risk first on. What they need to do is they needed to know how to mitigate and how to handle the events that came in. Risk management and compliance, they are called your second line of defense. Okay, and like your chief risk officer is the person who identifies risk, assesses it, and kind of gives advice on how to handle the risk. Then your third line of defense is your internal audit. Okay, what they do is they usually report to like the top people. Okay, that's just management. Basically on how the company's finances are, if they're good, if they're reliable, that kind of thing. But obviously we also need an external audit. Okay, and they are your third line of defense. Okay, so now what are your benefits of risk management? Okay, obviously it supports strategic and business planning. It incorporates risk considerations in all business decisions. Okay, it's really important to know that risk management needs to cover the whole firm. Okay, prevents excessive risk taking. Obviously, because of the saying, higher risk, high reward, people are willing to just take on risk thinking that they will get a higher reward. But obviously, risk management needs to limit how much risk the company takes. Okay, brings greater discipline to operation. Okay, which leads to better controls, they say. Leads to better controls. Okay, recognizes responsibility and accountability, improves performance assessment, enhances information flow, so better communication, increased transparency. Okay, and it complements compliance procedures and audit testing. Okay, so that's just identifying unlawfulness and fraud. Okay, the cost of risk management. So obviously we need a cost benefit to see how much resources we need to put into risk management. Okay, so what are the tangible costs? Okay, that's hiring dedicated risk management personnel, so like your chief risk officer and then people under him, putting more procedures in place and investing in systems, and you get your intangible costs, which are slower decision making and lost opportunities. So on a cost benefit, we need to see where we need to put more resources, most likely more to tangible costs. So tangible plus intangible equals total costs. What you need to take out here is just looking at the cost benefit of risk management. Okay, managing operational risks. First, we're managing people, which is your unintentional errors. Okay, fraudulent activities, rogue trading. Okay, that's when you bypass your management and place unauthorized trades. Okay, good HR management, so not hiring people who have criminal records. And structure of compensation. Okay, this is your risk reward. So if your company has a thing that says if you make $100,000 on each of your investments, what are you likely to do? Invest in risky things. Okay, and what can that do? That can lead to losses down the line. Okay, your managing systems, okay, like your system failures, employee behavior, hackers, that's quite a big one. Information protection, okay, Ashley Madison, did you hear that scandal? Okay, Ashley Madison is an online affair company, and they got hacked, and they had all of the clients, so they could have like affairs, and yes, and then they said they got hold of the people, and they said, if you don't pay, you know, we're going to spill the beans. So that kind of thing needs to obviously be in place. And another thing, employee behavior, downloading porn. What comes with porn? Viruses. Okay, so you kind of have to make sure what your employees are doing. Okay, compliance. Okay, this is within your operational risks. Policies and procedures should explicitly set out the delegation of authority and define clear responsibilities and accountability. So if you remember from ethics, I think it was like the second reading, you'll see it next year in level 1. Okay, the responsibilities and accountability usually lie with the supervisor. Now the supervisor has to have procedures in place to prevent the people below them from breaking any of the code of ethics and standards. If they do, not only is the person in trouble, but the supervisor is probably even in more trouble. Okay, segregation of duties is an important principle. No one can do everything, but you need to watch what everyone is doing. Okay, managing the environment, political risk. So if there's a new ruling party, how are they going to change the taxes, that kind of thing. Legal risk, external party sues. So you need to be careful of that. And settlement risk, what is that? That's your counterparty risk. So the risk of your client or the person not paying. Okay, so looking at compliance risks in further detail. Okay, so compliance risk is the risk that a company fails to comply with rules, laws, and regulations. Many people believe the trend towards less regulation contributed to the global financial crisis in 2008. Obviously now they're stricter and regulation and oversight is massive, so that's a compliance risk. Okay, in addition to applicable rules, laws, and regulations, many investment firms must follow guidelines from regulators, stocks, exchanges, kind of like your SEC. Companies should have internal reporting procedures to encourage employees to come forward and report instances in which they suspect someone has violated. What is that called? It's called whistleblowing. And the biggest whistleblower of 2019, that guy from Busasa. Yeah, I forgot his name, but he's a whistleblower and a half. Okay, examples of key compliance risk, corruption. Okay, we know that quite well. Tax reporting, okay, is complicated because the principles and rules vary considerably by jurisdiction. So where does Apple have its head office? Not in the US, in Ireland. Okay, so they use tax codes to minimize the tax owed. Okay, there's a technical difference between tax avoidance and tax evasion. So basically where you don't pay tax at all. Okay, then we also have insider trading. Okay, what's that blue chip company that went down? It's just gone. A Steinhoff. The guy apparently emailed all of his friends to sell before the company went public about all of the rubbish. So that's insider trading. Okay, and anti-money laundering to prevent money derived from criminal activities, and that's the big thing about Bitcoin was the whole money laundering thing. Okay, investment risk. You get 3 types of risk. You get your market risk. Okay, and that's just the price movements, the exchange rates, the interest rates, all of that kind of thing. Credit risk, what do we know? That's the credit worthiness. Who judges people's credit worthiness? The rating agencies. Okay, so what they do is they look at three things. They look at the amount borrowed. Okay, 2, they look at the probability of default. And what is the loss if they default? Okay, so a AAA company obviously doesn't really matter about how much they borrow. Their probability of default is low. And if they do default, what is the loss that they incur? Okay, and what is liquidity risk? It's the ability to buy and sell without loss incurring. Okay, managing market risk, which is risk budgeting. Okay, what do? We first quantify the amount of risk that can be taken by the company. So that's looking at the risk tolerance. So that's the willingness and ability. 2, they set risk budgets and limits for each asset class and or investment manager. 3, then they allocate assets in compliance with the risk budgets. And then 4, like always, the last step, monitor to ensure the risk budgets are being respected. Okay, remember, market risk can't be eliminated, but it can be mitigated. Okay, managing credit risk. Okay, so exposure limits. So they'll say, like, as soon as it hits 5% loss on $1 million, then we sell, we get out. Collateral and covenants, remember we had positive and negative. And if you have collateral, obviously that's better, it makes you more creditworthy. And transferring risk, like in derivatives, your CDSs. Okay, this is quite an important one, I would say, is your value at risk. Okay, this relies on statistical concepts such as your standard deviation. Okay, what is your standard deviation? It's the variability of your returns. Okay, the most important thing of value at risk, okay, gives an estimate of the minimum loss. Okay, so it's not the maximum loss that you can incur, it's the minimum loss. Are they likely to say, what is value at risk? Is it a minimum, a maximum, or some other thing? Please just remember it's a minimum loss. Okay, and obviously when we look at weaknesses, that's one of the weaknesses of VAR. Okay, and it's the minimum loss that can be expected for a given period. So for example, portfolio that has a VAR of $1 million for one day with a probability of 5%. What does this mean? This means there's a 5% chance that a portfolio will fall in value by at least 1 million in a single day. Okay, another way they could state this. Okay, so a VAR of 1 million at 5% is also described as a loss of 1 million or more, because it's a minimum. For this portfolio, it's expected to occur on average once in 20 trading days. How do we get the 20 trading days? It's the 5%, okay, and that's 1 divided by 0.05. Okay, now these are advantages over here. Okay, VAR is a standard metric that can be applied across different investments. Okay, it's not investment specific, it can literally be to anything. Okay, it's relatively easy to calculate, as we can see from the example above. Okay, a useful tool for risk budgeting, and it's widely used and mandated for use by some regulators. Okay, weaknesses of VAR. Okay, it's a minimum, not a maximum loss that can be expected. Okay, it does not guarantee that a loss in excess of VaR will not happen more frequently. Okay, VaR primarily relies on historical data. Okay, what happens in the past does not necessarily always happen in the future. Okay, it often assumes returns are normally distributed. Is that true? No. Okay, it is worth noting that the weaknesses related to VaR apply to all measures that rely on models known as model risk. Okay. Okay, so chapter 19, performance evaluation. I would say this is also quite a big thing in level 1, but it's split over various sections. So it's some in quants, some in portfolio management, some in fixed income. So it's kind of all over the place, but it is there. Okay, so performance evaluation process. Okay, so first we measure the absolute returns. Okay, what is the absolute return? It's the return received over a period of time. What is the downfall to absolute returns? Okay, doesn't take into account any risk. Okay, no risk taken into account. So then, obviously, what do we do next? We adjust returns. Okay, what is the goal? To have the lowest risk with the highest return possible. Okay, measure relative returns. So when we measure relatively, we usually relative to a benchmark. Okay, like your S&P 500, your Dow, anything you like. Okay, and what do we do there? We compare it and see if we should have made more money. Okay, attribute performance. So where does our returns come from? Does it come from the asset selection? Does it come from the sector? Does it come from the individual securities? Does it come from your exchange rates if you don't exchange in your own home currency? Or does the market in whole just have one big boom? So where does the performance come from? Okay, holding period return. Okay, we have looked at this before. It's your price at the end minus the price at the beginning plus any dividends or income that you receive over the price at the beginning. Okay, so normally returns, you say new minus old over old. But in holding period return, we just need to remember that some dividends might come into play. Okay, are they going to ask you to calculate it? No. So what do they know? Want you to know that it's just a return for a period. Okay, a day, a month, a year, or longer. What can they say? They can give you different formulas. So they can say your capital gain or loss, which is your P1 minus P0, plus your income, which is your dividends or your interest if you're in a bond, okay, divided by the beginning value. Okay, problems with calculating a fund's holding period return. Okay, many investments that pay income at different times. So if you get like a $5 dividend at day 1, at month 1, a $10 dividend at time 2. Okay, so obviously your holding period return for time 1 and time 2 is not going to be the same. Okay, deposits and withdrawals throughout the holding period. Okay, holding period doesn't take that into account either. It's just the amount you have at the end, the amount you have in the beginning, over the beginning. Okay, time-weighted return. Okay, quite frankly, I don't know what they would ask here, but because they're not going to ask you calculations. Okay, what I can say that they can ask is that the arithmetic mean is always greater than your geometric return. Why? Because of compounding. Okay, with investments, we tend to prefer geometric return than arithmetic return. And with your holding period returns, okay, see here, when you have different incomes, okay, you see it's -2 for the first period, 6.8 for the second period, and that's why they were saying different timing of cash flows makes a big difference on the returns. But they're not going to ask you to calculate it. Okay, adjusting returns for risk. Okay, what is the famous saying that I've probably said too many times? Low risk, high reward is what they want. Okay, so what they can say is they give you two companies. Okay, they say the return for both is 10%. The risk for company A is 5%. The risk for company B is 7%. Which would you want to invest in? Company A. Okay, take on lower risk if you're going to get the same reward. Okay, measures of risk, which is your standard deviation. Okay, I'm just going to use that little signal when I say standard deviation. You'll learn it next semester. Okay, so what is your standard deviation? It's the volatility, or they can say variability around the mean. Okay, so if we just want to write that definition quickly. Okay, so standard deviation is the variability or the volatility, okay, of returns around the mean return. Okay, so why do you think investors care about volatility? Exactly. So some think that past variables might be indicative of future returns. It's like an iffy situation. Don't count on the past for the future. Okay, and obviously, if we're measuring risk and we're looking at the risk, we can see if it meets your client's objectives. So, how does it affect your client's objectives? By taking on the risk. Okay, do we need to know how to calculate standard deviation for foundations? Most definitely not. Okay, the reason everything is squared here is because why? You can't have negatives in a square root. Really don't know what else they can ask. Okay, measures of risk. Okay, you get downside deviation. What does that mean? Investors, so people have done research, and investors dislike losses more than they like equivalent gains. So basically, if you get a 10% gain, you're going to be happy, but if you get a 10% loss, you're going to be very unhappy. So downside deviation is calculated almost exactly the same as standard deviation. Okay, but instead of looking at positive and negative, what is downside deviation? Okay, it only looks at the negative deviations, or by focusing on the outcomes that are less than some specified return target. Okay, not necessarily your mean. Your mean could be 10, but your downside target could be 5, and anything less than 5. Okay, we're looking at risk to reward ratios. Okay, so reward to risk ratios, this is really, really important. Okay, we're going to look at quite a few. Okay, reward to risk. So how do we measure that? Obviously, it's going to be your return divided by your risk. Okay, this is really, really important. The higher the value of the ratio, the better the risk-adjusted return, i.e., the higher the return per unit of risk. Okay, so if you get 2% risk and you get 4% return, or you get 8% return, obviously the 8% is going to give you a higher ratio, i.e., meaning a higher return per unit of risk. Okay, what's the goal? Maximize return, minimize risk. Okay, so the first one we're going to look at is your Sharpe ratio. Okay, this is massive in level 1. You will almost definitely get it. I can't tell you, but please learn it. Okay, so what is the Sharpe ratio? Okay, you're looking at the portfolio's excess return over the portfolio's risk. Okay, so your return on your portfolio measured against a risk-free return, so which is usually your government bonds, okay, divided by the standard deviation of your portfolio's returns. Okay, it's an important metric for understanding the quality of the returns purchased by a portfolio. So like we said, we want a high Sharpe ratio. Are they going to give it to you to calculate? No, but just know that the Sharpe ratio is the excess return on a portfolio divided by the standard deviation of your portfolio's return, and that you want a high Sharpe ratio. Okay, a similar ratio is your Treynor ratio. Okay, but now it's the same numerator, so the excess return, so it's your return on portfolio minus the risk-free rate, but now we're dividing by beta. Okay, going back to the other risk that we looked at, you get your sum, which is your systematic undiversifiable market risk, and that is measured by beta. Okay, so your Treynor measure is looking at market risk at the bottom. Okay, so it's your portfolio return divided by the portfolio risk, but using beta, which is the market risk. Okay, so like they said here, okay, note the Sharpe ratio uses the standard deviation, which is the risk for the firm, and Treynor uses beta, which is a portfolio systematic risk, which is the risk that they're exposed to at the market. So how are they going to ask you? They're going to say, how does Treynor and Sharpe ratio differentiate? And they'll say like portfolio return, I don't know, risk-free rate or measure of risk. And you have to know that it's a measure of risk at the bottom. Just that kind of thing. Okay, measuring relative returns. Okay, what do we usually relativate against? A benchmark. Okay, so what do? We determine a Sharpe ratio for both. And then what do? We compare them. Okay, what is this? It allows investors to look at the opportunity costs and whether investors are generating appropriate returns. So is your fund return, if it's similar to a benchmark, doing better, doing the same, or doing worse than a benchmark's return? Obviously, if you're paying an active manager and he's doing worse than a benchmark's return, think about who your investment advisor is and just say, please, passive manage me. Okay, the uses of some benchmarks, okay, they just use them for assessment. Okay, different types of benchmarks that are used is your FTSE 100 or the S&P 500. You can do whatever you want. Okay, for investors, knowing the financial market index that a fund manager uses as a benchmark will give them some idea of the return and risk they can expect from investing in that fund. Okay, alternatively, a manager might be given a specific mandate for reflecting specific risk requirements, return targets or style, sector preferences, etc., etc. Okay, criteria for selecting a benchmark. Okay, you need to look at the investability. So it should be made up of assets that a manager can buy and sell. Okay, so obviously passive, like I said earlier, it's going to be hard to mimic if you can't buy and sell all of the assets. But just as bad for active managers, because if they can't invest in the stuff in a benchmark, obviously it's going to be a lot harder for them to outperform the benchmark. Okay, compatibility, it should match the investor's objectives. Okay, always. And how do we look at that? Through the IPS. Okay, we're going to look at their level of risk ability and willingness to take on risk. Okay, clarity, the rules for construction of the benchmark should be clear. Okay, so all process and methods used, you always need to disclose as much as you can. Okay, and pre-specification, it should be specified in advance. Obviously, just make sure your client's objectives and expectations are met. Okay, then we get something called the tracking error, okay, and the information ratio. Okay, so remember that graph we had earlier, and it was like the benchmark is like, okay, no, the market's never that smooth. Okay, that was your benchmark. That was your passive. And that was your active. Okay, so now what the tracking error is it's the difference between the benchmark, and your portfolio. And that's what the tracking error is. Okay, so it's measured by taking the standard deviation, which remember was the variability from the returns of the difference in the standard deviations of your portfolio and the returns on the benchmark. So calculate the periodic differences between the returns fund and returns on its benchmark. Okay, tracking error of the fund is the standard deviation of those periodic differences. Obviously, the larger the tracking error, the larger the deviation. So that would be like, here would probably be the largest tracking error, like that. Okay, what do we want? Obviously, we don't want a massive tracking error. Okay, would a passive or active manager have a higher tracking error? Definitely, yeah. We'll definitely have a higher tracking error. Okay, why? Because they're going to be using their own methods, investing in their own stocks, and whereas passive is just trying to match it. Okay, after we've got the tracking error, there's something called an information ratio. And this is just another type of reward to risk ratio, so like your Sharpe and Traynor. Okay, it's the average of the periodic differences dividing by the tracking error. Okay, I found that quite hard to understand, so I'm just going to show you what the formula is. It's much easier to understand. Okay, it's the return on the portfolio minus the return on the benchmark. So remember in the previous ones, it was return on portfolio minus risk-free rate. Okay, so now we're minusing the benchmark divided by the tracking error. I just found that a lot easier to understand than the average of the periodic differences. All it is the difference between the return on the portfolio minus the return on the benchmark. Okay, if the information ratio is negative, the fund is underperforming. And obviously if it's positive, it's outperforming. So if it's underperforming, we can see that the return on the portfolio is obviously less than the return on the benchmark, and that is not good. Okay, this is just a FYI, but we can discuss at the bottom. Okay, if your average deviation is negative, okay, obviously we can see that it's underperforming. Okay, divided by your tracking error of 0.84% equals negative 0.53. So we can see that it supports the underperformance of the average deviation. Okay, so what does that mean? That you're not investing in the right stocks or the right ratios or whatever you're doing wrong. Okay, then we get alpha versus beta versus luck. Okay, what is luck? Okay, we all know what luck is. Beta is your market risk. Okay, so how is the market return affecting? And alpha is your manager skill. Okay, so we're just going to look at this. Okay, so remember what does a passive does? He buys and hold. Okay, obviously that doesn't require a lot of skill. Okay, just copying a benchmark. But active, obviously you need more skill to outperform the benchmark. Okay, so what they said here is movement, even if your portfolio is doing well, okay, it could just be due to a huge market boost. Okay, it doesn't necessarily mean that the manager did well. Okay, so when you have a manager, an active manager, he's going to want a percentage of returns. Okay, but now what happens if the market is the only reason you've done well? He shouldn't really get those returns. So this is just looking at where, if we remember from the beginning, just where the attribution comes from the returns. Okay, so luck, you need to distinguish between luck and skill as well. Okay, so we can use these two together and compare them to a manager's skill. Okay, here they've just boosted up the skill. Okay, so skillful, you need to consistently add value to a portfolio. So that's quite important. You need to consistently do it, not only when the market booms. Okay, and it's adding value above whatever the market-driven changes. And this difference, the difference between what a manager earns and what the market has made, that is called alpha. Yeah, so the outperformance. The outperformance. Okay, now this is probably one of the most important formulas in finance, the CAPM model. Okay, what does it stand for? It stands for Capital Asset Pricing Model. Okay, performance evaluators try to distinguish these three sources of fund manager returns. So what were they? It was luck, it was skill, and market return. Okay, by using these factor models to determine the factors that make up returns and importance for each factor. Okay, so CAPM gives rise to systematic risk, which is your market risk. This is the, do you know the CAPM formula? Yep. Okay, so CAPM is equal to your risk-free rate plus your beta times the market return minus the risk-free rate. Okay, very, very, very important. Okay, factor models such as CAPM separate the fund's performance into return from your market performance, which was your beta, your luck or randomness, which was your RM minus RF, and the investment skills of the fund manager. So both of those. Okay, attributing performance, which we kind of discussed a little bit earlier. Okay, can either come from your asset allocation, it can come from your sector allocation, your stock selection, or your currency exposure. Okay, so when you're looking at your returns and you need to do your rebalancing or adjusting, okay, you need to see where your performance came from. Okay, is it from your asset allocation or your sector, your stock? Do you need to change your stock if it's not doing so well? Is it your currency exposure? So the only reason you did well is because the rand weakened against the dollar, that kind of thing. Okay, performance attribution. Okay, so what they do here is they say, let's look at what your benchmark return is. So what do? We say your benchmark weights times your benchmark returns, and that gives you a return of 9.2%. Okay, then we take your portfolio asset allocation. Okay, but now what do? We times the portfolio weight by the benchmark return. Okay, and then we see that it comes out to 8.8%. So we can see that we've done worse than the benchmark if it was at 60-40. Okay, we had swapped the weights, so we had 40-60. So therefore we can conclude that the decision to put more weights into the S&P 500 reduced the return by 0.4%. So that is something they can give you, but obviously they'll give you the 9.2% and the 8.8%, and you have to be able to say, yeah, the S&P 500 overweighting is what brought down the return. Okay, I've never seen a foundations exam, so I'm not too sure. The exams I set were based on CFA level 1 questions that were in here. So just theory, no calculations. So it could be a lot harder than the foundations exam, but at least you'll know everything. So continuing from the previous slides, portfolio return was divided into 3 components. Okay, it was the benchmark return minus the asset allocation plus the stock selection return. If we just go back here, if the actual return on the portfolio was 9.5%, then the difference of 0.7%, so that's your 9.5 minus your 8.8, was from stock selection. That was just an if. Okay, they gave us that return. Okay, so note, more analysis could look at stock selection in the FTSE versus the 500 portfolios, effect of currency exchange rates, etc., etc. So it's not just based on weighting.